episode 16 of Top of Mind with Consilio Wealth. On today's episode, we are going to be talking about update on interest rates. The Federal Reserve came out and announced their latest interest rate move, as well as other central banks around the world came out. And there's a divergence of policy now, so we got some interesting things to talk about there. We're going to give a quick earnings update. Big Tech is released, so we've got some mixed news there based on what was released. And the dreaded inverted yield curve. It's been inverted for a while now, so we thought it would be helpful to unpack what that means. Why are there all these articles that talk about how the inverted yield curve always leads to or predicts a recession? We thought it would be helpful to unpack all of that. So to kick us off, let's start with update on interest rates. And the Federal Reserve raised interest rates by 0.25% most recently. And Hal, let me turn it over to you to unpack that, and as well as we can talk through some of the guidance that they issued here at their last meeting.
Sure. Yeah. And thanks, Chris. And hi, everyone. I think the Fed decision and Jay Powell's following remarks have a lot to do with the rally that has recently faded. It's Friday, February 10th at 9:40 Pacific. So right now the market is flattish, except for the NASDAQ has given back some of its year beginning gains, which has been pretty powerful. So as expected, there was no surprise about the 0.25% rate hike. But the surprise was some language that he used, and he used it again the next day. And that's the term disinflation. And we've heard about these new terms about transitory and obviously inflation, but now we have a new term to digest is disinflation. Mm-hmm. What that means is inflation's still inflating, like prices are still going up, but they're not going up as fast. And to be clear, this is not a situation where we're looking at deflation, which I think is incredibly bad. If we look back in history, the 1930s had deflation. And so much so that, farmers, specifically milk producers, were not willing to sell their eggs or milk for what they believed was a fair price because they had labor, they had farmland to tend to, right? And if the price of milk is crashing, they're not selling the milk. I think if you look at or Google photos of milk farmers dumping their milk in the 1930s, there were riots over this. So this was big bad news. So let's get deflation out of the picture, right? I know some market or money managers, specifically like Kathy Wood, are saying deflation, which I think is just such a dangerous economic environment, which you do need a severe recession to have significant deflation. And that's a term that I think we aren't even considering at the moment. So disinflation, after the bit of the detour there, disinflation really gave the market charge, meaning we're seeing disinflation in non-housing services, which is super specific, but you think about anything that's not housing related, that's restaurants, that's airlines, that's car rentals, yada, yada, yada. The price increases are slowing down, if not coming in flat. Mm-hmm. Yes, they're going to be higher than they were in the last 2 years, but we're no longer driving faster on the freeway. You're still driving 75, but we're not speeding up to 90, 100 miles an hour. And I think the market really honed in on that one term like they did in the summer, and we got a rally. And I know last week we talked about whether it mattered or not if this rally was for real or not, right? For long-term investors. Again, we don't recommend any day trading here, but a lot of people are coming out and saying, hey, this is a false rally. This is based on expectations and conjecture. But that's what the market really is. It's forward-looking, and you could see the money on the sidelines has just been anticipating something like this, some kind of green light to jump into. And I think that's what we're seeing now and what we saw in July. Was it premature in July? Yeah, maybe. But did it ultimately matter? No, maybe not, because we still ended the year not as bad, but we didn't end the year positive.
So there's been a divergence here as well. The Federal Reserve came out and they said we're going to raise by 0.25, and I believe they gave guidance that they're going to raise likely by 2 more times of 0.25. Is that what they came out and said?
Their forecasts say 2 more times. The market's saying 1 more time. So there's a bit of that's the divergence.
Well, what I was getting at there was the European Central Bank raised by 0.5.
Yeah.
And they came out and said, we're going to do that again in March. And they said they expect a strong European economy, which is maybe surprising, but good.
Surprising, yeah.
But that China's reopening would keep inflation elevated. And then the Bank of England also hiked by 0.5%. But they suggested that rates may have peaked. Lastly, the Bank of Canada hiked by 0.25. Their rates are only at 4.5, so quite a bit lower than where we are here in the U.S. And they said they would essentially hold as long as inflation has tamed. So what do you make of all this? There's the U.S. was the first to raise and the fastest to raise by far.
Yeah.
What do you make of what's going on now?
Yeah, and as a result of us being the quickest to the exit was the dollar strengthened, right? So interest rates dynamics are a global phenomenon where if I wanted to invest in euros, I would expect a certain amount of interest in return. So when I exchange back, I hopefully make money when I exchange back to US dollars, vice versa. When our central bank raised rates faster, that we got higher interest on the US dollar, right? Couple that with tons of other factors where Europe was expected to have, a recession and China was locked down. So all this money funneled in and strengthened the US dollar. Now, over the past 4 or 5 months, we saw the US dollar peak and then come down and it started weakening. And people we've talked about it before, people need to get over the fact that the term strong or weak isn't necessarily good or bad for one or the other, right? A weak dollar actually improves our exports, right? How many Teslas do we sell worldwide? And how much will that help, Tesla sales? Because relatively speaking, buying a Tesla overseas is suddenly more affordable. So is the petrodollar, right? We mentioned gas and oil is priced to or pegged to the US dollar. So if the US dollar weakens, that makes it suddenly more affordable. I don't know if it's completely affordable yet, but that is bringing relief to your international space. And by no surprise, international has beaten the U.S. on the 1-year trail. And that's mostly since October because they've been keeping track with the U.S., if not doing worse. But it's actually jumped so high in the last 4 months that it's not only caught up, but it's exceeded U.S. performance.
So that's interesting. So we talked about that a little bit last time. We talked about how international stocks have done better than the U.S. in the short term, and that's almost a long time coming because they've been such an underperforming asset class for so many years. Do we think this is a sea change, or do we think this is a blip on the radar due to dollar strength and dollar weakening?
Yeah, I think it's a bit of that. The dollar dynamics are always going to be fluid. Anyone who trades on currency knows that it's not for the weak stomach because the volatility on currencies is so strong that if you're trading on the basis of that, you're going to win and you're going to lose at random. That's just how the currency market works. The other sea change would be the possibility of no recession, at least through this winter, because the reserves are near 100% in Europe. England, though, is concerned, right? They hit a cold snap a few weeks ago, and they offered credits or rebates for people who don't use energy. So we know how sensitive that is, and I would never invest based on weather because weather always changes. I don't know what we're quite not out of winter yet, until March. So we got 6 weeks of potential winter left in Europe. And if they don't have the oil supply line, which I think they're working on now, it takes longer to set up new trade routes. And I think hopefully they could get it in by next winter, but the issue is getting through this winter without a cold snap.
Yeah. Okay. So let's just shift over to mortgage rates, because mortgage rates have come down actually in the face of the Fed increasing rates. We've talked about this a few times over the course of the Fed increasing rates. When they've given certain guidance, they'll raise by 0.5% or 0.75%, but actually interest rates go down, which is sort of interesting. So I have this article here from just about a week ago. Mortgage rates tumble below 6%. Relief is creeping into the real estate market in the form of lower mortgage rates. The average 30-rate mortgage rate is now 5.99 for the first time in months. So what do we make of this? Can we just explain for our listeners why, when the Fed raises rates, do interest rates sometimes go down?
Yeah. I think if you were just looking at common sense, the Fed raises rates by 0.25%. Everything else goes up by 0.25%, but that doesn't work like that. And we'll get into what the Fed can control and what it can't. But this is a bit of financial conditions easing by that one term, disinflation, right? Jay Powell came out much softer, we call that dovish in this world, than what he has been, which was hawkish, meaning we're going to stamp out inflation and we're going to keep raising rates until it's gone. Then all of a sudden we start hearing terms like disinflation. Not just we, the entire market, right? What we're talking about is public information. And not only has everyone heard it, they've already acted on it and they've already priced out future rates on that. So mortgage rates coming down, I think that's one of the last things we need right now, because housing has such a domino effect in terms of inflation, where if people are suddenly seeing equity in their homes, they're gonna tap into that. They're gonna remodel their backyard or their house, right? They're gonna buy cars with it. They're gonna consolidate credit and spend more. So it has this cascading effect of new spending, which I think is good, and I think that's what our credit system is allowed for. But when inflation's still around 4% in terms of PCE, do we need something to reignite that fire? So the 7 to 10 year Treasury is typically tied to mortgage rates. You might be saying, well, everyone pays the 30-year fix. Why don't we peg it to the 30-year, Treasury? Well, one, refinances happen, but two, mortgages are amortized, meaning I have a 30-year loan, I'm paying it down, so the principal owed shrinks over time, right? So typically what we see is the combination of refinances and the paying down of mortgages. A 30-year fixed mortgage actually lines up pretty closely, or broadly the mortgage market lines up with the 7 to 10 year Treasury.
Interesting.
We saw it start at 4% this year, came down to 3.3, 3.4. It's back up, which is probably one of the reasons why the stock market is giving back some of its gains. But I think that's what's needed, at least for the time being. We just need to get clear of this inflationary environment.
Interesting. So what I heard there, though, too, so there's sort of two types of loans. Let me just unpack something that you said there. So
sure.
Let's say that you have a home equity line of credit or a securities loan, like a margin loan on your investments. Those are typically tied to something called Fed funds or prime. And when the Fed is influencing interest rates, we technically say they can't control interest rates, they can influence them. Yep. So if they come out and they raise their benchmark rate by 0.25, that affects things like the prime rate, the overnight lending rate, the Fed funds rate, this type of thing. So when you have a variable loan, your loan will go in the last number of months here, really year, up as the Fed increases interest rates. But when you have a loan that is sort of influenced but not directly by the Fed,
correct,
it's more floating based on what the market is pricing in.
Correct.
And that's why if the Fed comes out here as they did and they say, hey, we're going to still raise, but not by as much, the market may have already priced in a more aggressive rate policy. And so based on the Fed's comments, when they come out and they say, hey, we're going to do less than anticipated, that's why longer term interest rates actually can come down, because the market then reprices this new information. So it's a little bit wonky, but that's why you see longer term rates like mortgage rates. The last actually number of times that the Fed has raised rates go down, because their guidance has been pretty positive with the outlook on inflation and the work that they're doing.
Yeah, and there's so much cash that's been built up from selling in the last year. You could tell when January turned, everyone was looking for somewhere to park that cash. And we've been saying that it does need to find a home. It doesn't have to be the stock market, but it's going to come in the form of spending, investment, yes, savings. But we're seeing the savings rate, the M2 money supply, like in terms of the entire country, actually shrink for the first time in its history, right? Money supply typically grows. So we've had M2 actually shrink in the last quarter.
Is that
which is good
money
for
on the
inflation.
Sidelines?
So M2 is money in money markets, savings accounts, checking accounts.
Okay.
And it's just a measurement that the Fed looks at. It's always grown because when I buy a car, that money is financed from a bank, but that finance money goes to another bank, who in turn finances it again for another car, right? That exponential growth of money. We actually had shrinkage of that. And the other key would be velocity of money, how fast the money circulates through our economy. And that's been shrinking too. So we're seeing a lot of like underlying fundamental data that shows a slowing in spending. So I know we see headlines of, hey, people can't afford this or that. Those people probably don't really move the needle because we're talking trillions of dollars. But M2 money supply was 20 trillion. It's still hovering around that rate, but it is not growing up to 21 trillion, 22 trillion.
So, but that would suggest that people are spending more than they have in the bank. If I have $1,000 in the bank and I have $1,000 of income and I spent $1,500, now I only have $500 left in the bank. That's what's affecting M2?
Kind of, because when you spend that money, it's at a merchant. Where's that merchant? The merchant's banking somewhere. So that money.
Got it.
Yeah, the M2 does.
Their bank.
Yeah. But if you're not creating new money, loaning out, giving new credit, that kind of thing, that has an impact on new deposits.
Ah,
yeah.
I see. Right. Because so different example, I buy a car, it's 50 grand and I put 5,000 down and I finance 45. The 45 was created via debt. Yeah.
It's backed by deposits. We'll get into that.
Yeah.
We'll get into that when we talk about the yield curve. But yeah, you hit it. It's at 40, that full 50,000 is going to go to the car dealer's bank, whoever they bank with. Yeah.
Yeah. But not out of my bank. Therefore,
exactly. Yeah. So the fact that the overall M2 just shows there's, new money not being created, or credit specifically not being created to allow for new deposits.
Give me an example of velocity of money. Help me understand that better. What does that mean?
In terms of physics, velocity is the speed of something, right? Or sorry, I'm butchering physics completely. But velocity of money is how fast money flows through the system. So if you're not buying a car, that 50,000 is not moving, right? It's stuck at your bank. But if you do buy a car, that 50,000 is in velocity. It's moving to another bank. So they, in turn, will loan out another 40,000, right? Banks have to keep a certain amount of deposits, but they can loan out the rest above the reserve requirements. I'll get into that as well. But yeah, that's how money grows and grows and grows, by spending, or specifically by credit.
Okay. So velocity is a measure of economic activity. If velocity is lower, people aren't out buying cars or buying homes or doing, spending with debt and whatnot. Yeah. Velocity is higher. There's a lot of that economic activity.
Yeah. And if we looked at a velocity chart, it's actually been coming way down since the 80s. So the people that really control velocity of money are big institutions. And we've had velocity really come down. So to where that's probably one of the big reasons why inflation hasn't been an issue in the last 40 years, because it wasn't, money wasn't circulating like it has been in the 50s, 60s, 70s. Right? We talk about 70s inflation, but 60s inflation was still around 7-8%. So the velocity of money, I think, is the key to creating new credit, new deposits, new M2 money supply.
So you're saying there's less economic activity today than there was in the 60s and 70s?
Less economic actors, meaning again, it might be the bigger spenders are concentrated to the top, the top earners who simply don't spend what they take in, right? Because we know the bottom 85% or so of wage earners are spending 105% of their wages coming in, right? They spend more than they take in. That the dynamics shift for the top earners, where they only spend 60% of what they take in. So that 40% isn't in velocity anymore, at least in the sense that we're thinking of spending and inflation. They're investing, obviously, but
as the country has gotten richer over time, due to, in what you're saying, if I'm worth $100 billion, I'm not spending nearly the percentage of that as I would be if I was worth $100 million.
Jeff Bezos isn't spending $105 billion.
Right.
Yeah, because it's well, he's not entirely liquid either. A lot of it's tied up in Amazon stock. So if he sold all of his Amazon stock, that's what I'm throwing a ballpark number out there. That's a 10% volume hit.
Sure.
Assuming he owns 10% of Amazon. I don't know the exact figure, but I think you get what I'm saying is a lot of the net worth is tied up in assets that they can't sell or probably shouldn't sell.
Why don't we shift over to the yield curve? I think this is a decent segue into that. So the yield curve is inverted. It's been inverted for a while. And let's just take a step back, too, for our listeners and explain what is the yield curve and what does it represent and what does it mean when it's inverted?
Yeah, the yield curve is just a fancy, I guess, term, Wall Street term, to say what are 1 year loans paying and what are 30-year loans paying, right? So between maturities from zero, really, all the way to 30 years out, what are the individual interest rates that are showing up for, committing your capital for longer, right? If I were loaning out money and I had an option of loaning out for 1 year or 20 years, normally I would expect more interest in return for giving up my money for 20 years, right? That's a long time. But that's in a normal market. What we're seeing now is loaning out my money for a shorter period of time, 1 to 2 years, is actually getting me more yield than loaning out my money for 7, 10, 15, 30 years, because that's what we call by inversion. And that's what we're seeing, direct response of what the Fed can control and what the Fed can't control. So we mentioned the 7 to 10 year is more tied to mortgage rates. If that is getting depressed by demand, domestically and internationally, that's going to bring down the 7 to 10 year, and that should bring down mortgage rates, right? The Fed has no buying or control over that part of the curve, right? What Chris mentioned was that overnight rate gets toggled up and down. What that means is if I'm Bank of Hao and Chris is the Bank of Chris, right? He takes that $50,000 car loan and he loans out all $50,000. But in the United States, our banks need to hold a certain amount of reserves on cash in case those $50,000 in savings are withdrawn. So if he loans out $50,000 and he needs to carry $5,000 at least in his vaults, he has zero. So he goes to the Bank of Howe and says, "Hey, can I borrow $5,000 to put in my vault? So when I get, under the watchful eye of regulators, I have the required reserve amount on hand to pass muster, right?"
Mm-hmm.
Then once they inspect my books, I send it back to Howe and pay the overnight rate. That's where the Fed's impact is. So I'm borrowing, or I'm lending out to Chris for 4%, so he could pass reserve requirements, which no bank has it running into right now. But that's what banks are when you hear the term borrow short and lend long, because to cover those $50,000 worth of loans, he needs $5,000 worth of cash on hand, right? Mm-hmm. If that $5,000 cash on hand is costing him 4%, and that $50,000 loan, which is let's say a 7-year car loan, is bringing in maybe 2%, I'm losing a net of 2% on the cash that I have to borrow and the cash I'm loaning out.
Mm-hmm.
You see where the inverted yield curve suddenly starts slowing down the economy? Because you're the bank of Chris. You don't want to loan out money anymore, especially if car loans, mortgage rates are below what you have to pay in deposits, which we'll get in. You're probably yelling at us like, "Oh, my Wells Fargo or my Bank of America is paying 0.06%, right?"
Yeah.
They're paying nothing. But you go to Ally Bank, at the time Mark is paying 3.5%, 4%, right? Mm-hmm. So it's a supply demand. Those big banks don't need new money because they're not loaning out, right?
Yeah, I've read that they have plenty of capital on their balance sheet, so they don't need to incent more cash, which is why we all aren't receiving really anything in our bank accounts. But you go to the smaller banks, they need the cash to make these reserve requirements that you're talking about, and so they're actually paying something that's more like a market rate.
Yeah, so if you think about it in a macro sense where you combine all the banks collectively, if it costs them to loan out money, like they're actively losing money by loaning out money on a collective, what do you think that does to the economy? If they're not approving car loans, if they're not approving mortgage loans, I know they are, but that activity slows down because they're not making as much of a spread, or they're actually inverted in the spread where they actually could be losing money.
I can see how you're saying they're not making as much. I guess where I'm hung up is, again, $50,000 car loan. $50,000 car loan at, 4%. And that's a 5-year loan. And then you're saying the bank needs to borrow some money potentially from another bank to meet their reserve requirement. And maybe they're paying 6% on that money, 5% on that money. So they're paying more. But if they're earning 4% on 45,000 and only paying 6% on only 5,000, the net is still a positive cash flow to the bank.
It will.
The bank's still making money. It's just that the margin is less.
Yes.
Because in the olden days, it was, I don't know, 0.25% to loan that half, 5,000, and maybe still 2% for the 50,000.
Exactly.
Okay.
So that's why an inverted yield curve has always predicted
things.
Yeah, it slows things, because every recession has been predicated by an inverted yield curve. It doesn't necessarily mean since we're suffering through a yield curve inversion, doesn't mean a recession is 100% guaranteed, if that makes sense.
Because the yield curve can uninvert.
Yep.
And this has happened many times. It will invert and then uninvert, and we don't have a recession. So it's not. So what you're saying is that when so recessions happen during inverted yield curves, but sometimes inverted yield curves uninvert, and then we don't have a recession. Yeah. So if you're banking on a recession because of the yield curve inversion, yes, there's heightened risk of that because lending is not as profitable. So when you don't lend, the economy slows. But let's say the economy slows enough to where inflation goes away and the Fed starts cutting rates on the short end, meaning your car loans are still 4%, right? Or whatever figure we used. But all of a sudden, to pay for the overnight rate between the Bank of Howe and Chris, even though it's a small fraction of what we were actually, exposed to or lent out with, it's still it becomes that much cheaper. That
that's what the market is pricing in right now, is a Fed pivot. We think there's a pause, so the Fed will go up to 5% and just stay there for a few months. The market's saying the Fed needs to cut rates because we're facing a severe recession if they don't, meaning they need to make lending as profitable for banks to keep money circulating back up again, right? That act in itself is inflationary if you're a little too early with it. That goes back to the 70s where Arthur Burns was, oh, we got a recession, let's pivot and cut rates. Then all of a sudden that spurred or rekindled the inflation fire.
So when a yield curve inverts, is there a certain amount of time that on average produces this apparent recession?
Yeah, historically it's been 8 months to 18 months. So yeah, if you see a yield curve inversion, we've been inverted since the late summer. So it's been a steep inversion and a very long and drawn out inversion. But should we use that historical average as, an outlook to the future? I don't know. We're coming out of a post-pandemic situation here where supply chains were snarled, labor force issues are coming up, right? There's all these things that were pandemic driven, and to unwind all that, I don't think there's a playbook or historical precedent for this.
Every time a yield curve uninverts and then reinverts, do we reset the clock on that 8 to 18 month?
I think it does. For it to but that first inversion counts as an 18-month clock. So you can have that yield curve invert, uninvert, and invert again. Meaning if we get like a full-fledged European recession, the U.S. doesn't need one. All that money from risk assets in Europe suddenly start piling into U.S. debt. And that pushes our yield curve down further. So that makes it even tougher for U.S. domiciled banks to transact because their spreads are that much tighter. They're still making money, but it's not as beneficial to them to loan out money if, let's say, the mortgage rates go back down to 4%. Right? There's going to be a ton of mortgage demand, but banks are probably going to raise their standards because they don't want to lend out that kind of money, especially if their 1 month rate, their overnight rate, is around 4%.
Interesting. Yeah, I certainly agree. We're in uncharted territory. I mean, we always are, right? It's so I think we can use history. Those that listen to us regularly, we use history on if you're diversified, you'll be okay long term, which that's a pretty good bet. But the rest of these things, if you're trying to predict the recession or interest rates or this, that, and the other, man, it's hard. Yeah. It's hard to get that right with a high degree of success. So we would certainly caution outright calls for certain economic changes based on one or two factors because these things are always different.
Yeah, and there's a lot of reasons headline wise to sit out this rally. A lot of the smart money has been lagging, right? A lot of active managers are about 80% of them beat their respective benchmarks last year.
Wow.
I think we talked about it pre-podcast, but it never came up during the recording. But 80% beat their benchmarks.
It's usually the inverse of that.
It's the inverse.
It's usually 80% miss.
Yeah. The reason why they did it is they held so much cash. So cash saved them, right? And guess what's happening now? Only 29% are beating the benchmark this year. It's because the
market rallied.
They didn't invest their cash. So if you're paying someone,
that's
something we watch for. Yeah. If you're paying someone to invest your money, why are they holding cash when, again, cash is earning 4% depending on where you look. But why are you paying someone to not invest, basically? And I think that's one of our bugaboos with active investing, which again, we're not
drag.
Yeah, against or for, but it's just something we watch out for. So if you have all these smart money managers, right, lagging the market by use again, that's a Wall Street term, dumb money for retail and smart money for not the institutional players. They're not necessarily smarter, as 2020 proved out, 2021 proved out. So that's that's the dynamic of the market that we're looking at. So this kind of proves that is a retail driven rally, but so is 2020. Just because retail's leading doesn't mean it's a dumb rally or a false bear market rally.
It's interesting too, is that I had been reading that Tesla stock has been the most purchased stock out of all the other stocks, and it's primarily driven by retail money. And retail money is, you hop in your Robinhood account or your Fidelity account or whatever, and you buy a share of Tesla. And you and everybody else that does that actually creates a ton of inbound money into a single stock.
Buying pressure. Yeah.
Buying pressure. Yet
more buyers than sellers, right?
Don't give me that again. Yet in the face of all that, Tesla stock has gone down, or did go down quite significantly in the face of all of that buying pressure, which should have been supportive, and then hit an apparent bottom, or at least bottom for the time, and then skyrocketed since that point. I think it's up 100% from its bottom now, which is a crazy run in about a month worth of trading. So
from a business point of view, their margins went down from 30% down to 20% and even tighter after these price cuts.
Right. Yeah.
That shouldn't be celebrated in a fundamental sense, because on a per unit margin basis, that company isn't as profitable as it was in 2019.
Which is interesting, right? Because the market would then suggest, okay, it might be worth less because Tesla holds they're the king of margins in cars. No one touches them, gets anywhere
the
close
Apple
to the
of
margins.
Cars, right? You don't want to be the Walmart of cars, which is Ford or GM.
Right. Exactly.
Right?
Exactly. Yeah.
And they're being celebrated for heading that direction. That doesn't jive with me.
It's very interesting. Yeah. And I mean, it could be a simple case of less bad. Like we talked about in the past, markets will sell off in anticipation of bad news or really, really bad outcome or a recession, for example. And then if the news gets a little bit better, I shouldn't say the news, maybe the economic data gets a little bit better, the market might actually go up, or the stock might actually go up in the face of an otherwise bad earnings report.
Yeah.
Because it's a less bad outcome. And maybe that's what happened with Tesla here. They cut prices at the end of the year. No one knew where their earnings was going to land. No one knew if they were still selling cars. And then they came out and they said, our demand is still double what we can make. Like, this is still just insane. We have more buyers than cars, even though we dropped prices. And so,
which
our
is
margins
confounding,
eroded.
though. Yeah, if demand is that high, why depress margins, especially when supply costs
It's a good question.
Up.
Yeah.
And what we ultimately invest in is business profits. If a business is willingly lowering the profits to increase volume, I would always prefer the margin protection over volume growth. It's, again, we saw it with Lyft, who is off by 35%.
It's tanked, yeah.
Zero margin businesses do not survive.
Yeah.
So if you're heading down that zero-sum game, that shouldn't be celebrated, right? Apple's been Apple because the cost of the iPhone has never gone down. I don't know if I should say never, but the flagship, I know they offer offshoots, right? But they protected the margins in every aspect of their business. To see the price run up on Tesla it's confounding, because I want a profitable company that protects its margins.
It's interesting too, because I want to say when they raised prices at some point over the summer, they pointed towards commodities. They said, hey, the cost of building our cars has gone up. We have to raise our prices by whatever, $5,000 or something. They jumped by quite a bit. But when they lowered them, they didn't point back to falling commodities prices. And I think if that was the real case, it would have been smart to sort of point back to that and say, hey, we promised you we would lower prices when raw materials came down, which has happened. And then they didn't point to that. They just said, hey, we're cutting costs. And they sort of just secretly did it overnight. It's you don't really know what's going on, right? You can't unpack that fully. You just have to listen to an earnings call and make with it what you can.
Yeah, and I know we're getting towards the end of it, but if we brought it out to beyond Tesla, right? We just went through the big tech earnings, and it's been a pretty mixed bag. I know we wanted to talk about how Amazon had the biggest drop in
Amazon posted the biggest loss in their company history. So they lost $2.7 billion on $514 billion of revenue, which is, typical Amazon, right? Super thin margin, slight, swing to a profit, slight swing to a loss. But they basically said escalating costs were the main thing. And of course, they announced more layoffs as well. So, I think it's not surprising for a company that runs with such thin margins as it is. I think it'll be interesting too, getting through the next maybe 6 to 12 months with a lot of these tech layoffs. I think we'll get to see how profitable a lot of these big tech companies really are. And I think Amazon is probably a lot more profitable than they lead on to, because they historically have invested so much money in growing their operations and their bandwidth. And if they were to pause some of that, because say, demand has come down, I would assume that they would swing to some pretty insane profits, but that could be wrong. I don't know.
Yeah. And again, they like Meta, and I don't know about Google so much, but they all overhired, right? And they took these pandemic projections and hired based on that growth rate, right? And assuming that was going to happen last year in 2023. And again, small percentage ultimately leaving. I know we looked at a chart of the amount of hiring versus the amount of layoffs.
Yeah.
They're still very, very much net positive, like by 90+%.
That's my thing. I was like, did they overhire? They added,
Yeah.
I don't have it in front of me, but a company might add 10,000 people or 50,000 people, and then they hire off, or they lay off 2,000 people or 5,000 people or something. And it's like, did they really overhire if they're not rolling back the tape that far?
Yeah.
Obviously, revenues have grown, and we need more jobs, to do the work. But I don't know. I kind of feel like it is an opportunity for a lot of these companies, because there's other layoffs elsewhere, to say, hey, here's our opportunity to kind of cut on one of these areas that it was more research and development based, or maybe wasn't really making money, hasn't played out. Everybody else is laying off, so let's take the chance to just do it now. That way we don't look bad.
Yeah.
If one company's laying off a team and no one else is, it's weird. But now it's sort of the opportunity for senior leadership to look across the company and say, this area is underperforming. Let's just do something that everybody else is doing, and we won't look so bad. So, I don't know that. That's not a fact.
Yeah.
I'm not a C-suite executive at one of these companies, but I have to think that's a fly on the wall conversation in there. That's saying,
Sure.
Now's the opportunity. Let's just do it.
Yeah. Yeah. Let you use other layoffs as cover, right?
Yeah.
Yeah. And use it as, hey, we're looking out for the bottom line.
Let's pivot over to a couple of final topics here. So you have this note in here on one-trick ponies, and I just thought this would be kind of fun to talk about here for a minute. What do you have here?
Yeah, one-trick ponies. This is a fun article by Jack Rains. He is a young and up-and-coming writer, and he mentioned the guy who made Kyle Bass, who made a lot of money on bets against the U.S. real estate market, right? He bought a lot of credit default swaps, and famously, I guess he was depicted as one of the young traders in The Big Short movie with Steve Carell. I don't know if you watched that.
But I did.
He and his partner generated $30 million in assets, and they bet against the U.S. market, and that became a pretty fruitful bet. But since then, he's made quite a bit of bets that have not paid off, and I think a lot of it has to do with timing, right? He bet against the Bank of Japan, or the Japanese economy, that it would spiral, and he was wrong.
This is Michael Burry, right?
Michael Burry is another one, another person who was showcased in the movie. But yeah, this guy Kyle Bass was bet against the Japanese economy, that it would just implode. It didn't until 2022. So he made this bet in 2012.
Whoa.
So you're 10 years early. You're right, but you're 10 years early.
That's not a bet. That's a guess.
Yeah.
Well, they're all guesses, but
Yeah, well, when you're talking about the global economy, right? And there's these patterns of these guys who made a lot of money off of that one 2007, 2008 event.
Mm-hmm.
And they've been wrong since. And they've been chasing that big home run that works against what the optimistic point of view is. So Michael Burry is another person who was highlighted in the movie and in the book, that he made this similar bet, and his habit is to say, get out of this rally, it's crashing, it's all coming down.
Mm-hmm.
And when he comes out to be wrong, at least in the moment, he deletes his tweets. He might have other reasons to delete his tweets, but Jeremy Grantham, famous value investor, been calling for a steep, like Great Depression level of sell-off since 2011. Are you going to sideline your cash for 12 years? Right? And granted, we've been through the pandemic, 2022, right? But we also had 2017, 2019, 2021, 2020. Yeah. You're going to sit out all those years because one guy says something? I have a ton of respect for Jeremy Grantham above all, because he has a consistent career of still being successful while being bearish. But he's out there and he's being published by these by the news media with his forecast. Mm-hmm. And if you're wrong for that entire time, you can't rely on that as an investment thesis. I know there's plenty of reasons to be scared of the market, but there have always been since 2011.
Oh yeah,
right?
Every day.
Yeah, and Greek debt crisis, 2011 specifically, for the U.S. downgrade because of the debt ceiling limit, mm-hmm. which we're ironically living through again. But 2012, 2013, and beyond have been in amazing investing years. And there's no guarantee of that that's going to happen again. But are you willing to sit out because of a once-in-a-generation event would happen? I think we already got that. I think we already got it in 2020. So for something at that level to happen again, I think it would take a lot.
Mm. Yeah, well, you know how much I get into it with media and how there's constant negative calls. But yeah, it is amazing that there's these people out there that just consistently post negative things year over year over year. They're consistently wrong, and then they're right, and then they're famous for a minute, and then they're wrong again. And
they get brought back again because CNBC can't get enough of them. They're suddenly finance heroes. Everyone knows Michael Burry because of that one trade, but he's been wrong for consistent amount of time.
If you call a recession every other month, you're going to be right eventually.
Yeah.
So
yeah,
there you go.
And one last thing before we go, I know I butchered the price of eggs. I just wanted to clear that up. So that a pallet of eggs is 60 eggs. That was $24 and not $60. So I transposed. So still 50 cents a freaking egg is expensive. But
I don't know.
Yeah, headlines really drum up the I guess the pessimistic part of it, because prices of everything else has become steady, or if not come down. But eggs, I think we're going to see eggs come down. I think we saw wholesale egg prices come way down, but we'll see that on a lag, meaning if I'm a grocery store, I have a contract, albeit short term, with farmers, right? So got to work through that contract, and then the price of eggs should get much cheaper.
Yeah. I think I'm still seeing at the store, you can only buy 2 cartons of eggs. I think there's still the shortage sign. Like everybody remembers at the beginning of the pandemic, you could only buy 2 like things of frozen broccoli or whatever. You couldn't stock the fridge. And so eggs, I think I'm still seeing that sign there. So I thought prices came down a little bit, but anyway, thanks for clarifying. I didn't know how many eggs were in a pallet. Thanks for that. 60. Now we know. And then also $24, which not bad, right? I don't know. 60 cents an egg. I don't know what they should be.
Well, not as bad as they
reasonable.
Butchered it. Yeah.
Yeah. Well, it wasn't $60. Like I said on the last call, a buck an egg is a lot. That's a lot.
Yeah.
Right. Awesome. Well, this is fun as always. We will talk again soon.
Yeah. Hopefully it's insightful for everyone.